After this video, this book will be your property investing Bible, and it actually has nothing to do with property investing, but it's going to be your secret to success. And luckily for you, I'm going to break down the 6 key lessons from the book, so if you can't even be asked, don't even have to read it. Hi guys, I'm Jim, and along with my brother, we have a small property portfolio, and we help people build their portfolios up in the Northwest, completely hands-free. This channel is going to document my learnings and experience of what property investing is actually like, boots on the ground. So if you're interested in growing your own portfolio and learning a bit more about property, please hit the subscribe button and let's get into it. So why should a property investor want to read a book that doesn't even break down property investing strategy? Well, in my opinion, it's more fundamental than knowing strategies. We can all understand what a buy-to-let is or how big a HMO room needs to be, and that's what I'm doing on this channel. But apart from understanding technical property investing information, what else is going to contribute to your success? Well, in my opinion, it's the ability to make quality financial decisions. The reason we make decisions we do is an output of a lifetime of inputs into our brain. So we all need to understand why we make the financial decisions we do. The secret to this lies in understanding human behavior. When we understand the emotions, and more importantly the beliefs that influence the financial decisions, we can ultimately make better decisions, which is what we're all about on this channel. This is why The Psychology of Money by Morgan Housel is required reading for anyone who wants to improve their financial decision making. Morgan Housel is an award-winning finance writer and former finance columnist at the Motley Fool and the Wall Street Journal, along with being a partner at the Collaborative Fund, which is a venture capital firm specializing in technology. He's recognized for his ability to distill complex financial concepts into accessible and engaging narratives, making them understandable to a wider audience. Housel's work often delves into psychological aspects of investing, exploring the behavior biases that can influence financial decision making. So he's 100% worth adding to your content diet. Now, there are 6 key lessons that I've taken away from the book, so let's get into them. Why do so many people fail in mastering money? It's all around us at the end of the day. Most of the decisions in how we choose to spend our lives are impacted or even driven by our finances. Now, this could be the house you buy or the holiday you go on. This is the first key lesson from the book. Although we might feel like issues to do with money feel like a math problem, this is not the case. Everyone acts in a way that feels rational to them. This can vary from person to person. Something I might think is perfectly rational, you might think I'm completely round the bend for doing. For example, when me and Dan both pulled equity out of our own homes a few years ago to purchase our buy-to-let, I had a conversation with someone I work with who thought I was completely crazy. He didn't understand why the hell I was doing it. He was firmly in the camp of paying down your mortgage as quickly as possible so you can live a stress-free life after it. I've got a different viewpoint, and I wanted that money to work harder for me in a different asset. Why do people have these different mindsets around this sort of stuff then? Well, in the book, Housel argues it's not what you learn, it's what you live through which most affects your relationship with money. The reason for this is simple. It comes down to emotions. Although you can sit here and listen to me talk about property investing, until you've lived through the experience, you won't truly learn what it's like. The anxiety of waiting for a refinance or to find out if an offer's been accepted on a property can change absolutely everything. Someone might do this the first time and it goes really well, and they choose to carry on investing into property. Or someone might have lived through 2008, lost their job and their house, and they never trust the so-called system. So the idea of investing into property would make them run a mile, all because of how the previous experience made them feel. This means your early development can have a massive impact on your financial outlook. Think about when you're in your early adulthood. You might have left school or university and you're looking to start properly adulting. What do you mainly want? You want a good job market, you want things to not be too expensive, and you want the economy to be stable. If your first experience of this is a negative one, it's not unreasonable for this to have a long-term impact. He breaks down how key 3 areas can impact your overall outlook for the rest of your life. These being stocks, inflation, and unemployment. Let's take a look at stock. He notes that depending on your birth year, the stock market will have performed completely differently. For example, if you were born in the 70s, therefore reaching adulthood in the late 80s, early 90s, the stock market's had a good run, and you probably have a favorable view of it. But if you're born in the 90s, chances are you were probably hit in the 2008 recession when you were becoming an adult, which was not sound. Now, this is the same for inflation and unemployment. If you reached adulthood when inflation was crazy high, it would make you feel like you didn't have any money and everything was a really tight squeeze, or as the TikTokers call it, a cause he lives. Flip that round to entering the job market when there's lots of opportunity and you can bounce around from job to job, getting paid more and making you feel like you're making progress in your career. You would likely feel optimistic about this stuff. An example he uses in the book is Rick, who was born in the 1970s. He would view stocks as a surefire way to make money because they increased greatly in his early adulthood, which obviously, because of this, he's going to invest heavily into them. Whereas the 1950s born Pam might view stocks as an unstable investment given how little they've moved in their early adulthood and would likely mostly hold cash as this would feel safer to her. Now, both of these people would view each other's strategies as irrational, but the strategy is rational to the individual person. This explains why people didn't understand when we pulled equity out of our own homes to invest. They have their own mental model for investing, so although it might be rational to you, it could be deemed as completely irrational to someone else. The second part to understanding why people do not become wealthy, according to Housel, is they confuse being wealthy with being rich. Housel believes you can easily tell whether someone is rich, but you can't if they're wealthy. Now, this might be where you think about someone like Mark Zuckerberg or Elon Musk. They do not strike you as two of the wealthiest people on the planet because they look relatively unassuming. Whereas we all know that person who doesn't have a pot to piss in but can still afford one of those Balenciaga high-vis jackets. This is why choosing the right people to model yourself on is critical. It's easy to see and imitate people who are rich because they're normally pretty easy to identify. But you might spend all of your time trying to be like them and come to the conclusion that they're not actually wealthy in the first place. Lesson 2 centers around why we actually want money in the first place. And this is possibly my favorite lesson in the book. The real reason people want money is because it buys you control over your time, which I think everyone would agree would make most people happier. It's a difference between getting to do something and having to do something, like having to go to a job you hate. Also argues in the book that nowadays most people have jobs that center around being a knowledge worker, which fundamentally means you can always think about work, as most of it's inside of our own heads. Which means even if we're not physically in the office, we can still be thinking about the job, which boils down to spending more and more time thinking about our job, which results in us having less control over our time. But does money actually make you happy then? Well, according to Housel, lots of end-of-life interviews indicate that people value things they have the luxury to do because they control their time, which could be the freedom to develop quality relationships with your spouse or your children. So in this case, money can make you happier if you choose to spend the time correctly. Wanting the freedom which money can give you can also present a paradox. How do you know when you have enough? Although Housel doesn't give an actual amount, he does talk about the idea of becoming happy with enough is important to your financial success. He explains that some people are never satisfied, regardless of the amount of money they make. They still always want more of it. Have you ever achieved anything in your life and the day after that just feels like the new baseline? Well, this is called the hedonic treadmill, and this can be a potential pitfall for people who can never be satisfied. They carry on pushing further and further, and this drive can lead people to risk the wealth which they have made for more wealth which they don't need. I love this message from the book. When you can learn to be happy with enough money, which is going to be different for everyone, do not take unnecessary risks with your money. This sounds like a great idea, but what advice does he actually give to do this? Well, he advocates to stop increasing your lifestyle standards. If you always feel the need to upgrade your lifestyle, you're never going to be satisfied, which can lead to poorer financial decision making. This mindset can be best summarized by beautiful novelism. People who live far below their means enjoy freedom that people busy upgrading their lifestyles can't fathom. Lesson 3, what to include in your financial strategy. This next lesson is broken down into 4 major parts, but certainly has the most actionable advice to adhere to. We've learned about how we think about money, but what should our plan be moving forward? Step 1, using compounding to your advantage. Housel is a massive advocate for the benefits of compound interest. Now, there's that famous Einstein quote claiming it to be the 8th wonder of the world, but anyone who's invested for long enough will understand the magical benefits of it. Because of this, he argues how long you invest for is the most important factor when it comes to determining your investing success. This is even more important than annual returns, and he uses a perfect example. Warren Buffett is 75% wealthier than investor James Simmons, despite the fact Simmons' annual returns are triple Buffett. The reason why? Buffett's returns have been compounded for 40 years longer than Simmons. The long-term benefits of compounding can be applied to property investing. This is why whenever you hear a serious investor talk, they will normally say their exit from a property is death. This is truly understanding the power of compounding. Step 2, make saving money a priority. The next step of a solid investment plan is to make sure you place the right priority on saving money. Housel considers saving money important for 3 reasons. Saving is essential to building wealth due to the nature of wealth. Housel lays out that wealth is money you do not use. It's money you save, which in turn means you can't build wealth without saving money. Second, saving is the most surefire way to build up your wealth because it's totally within your control. Investing or increasing your income can be full of uncertainty. Look at the economy the last few years. But saving is not. You have full control over how much you save. This point is the one I have the most divergence with overall. Although I completely agree we should all save and we can all move the needle the most when it comes to this. Focusing on growing your income will turbocharge how much money you can save. So for me, you should always be looking to do this. This is exactly what I'm trying to do on this channel. So if you want to support me on my property investing journey, please consider subscribing below. The final point is saving is the simplest and easiest way to build up your wealth. It's easier to save money you already have than to increase your income or investments. But I think you should try and do both. So sorry, Morgan. But why do so many people struggle to save money? Well, there's a quote from Will Smith, and he says, "We spend money that we do not have on things that we do not need to impress people who do not care." And this is why people struggle to save. They're too worried about other people's opinions and feel like they need to stay in the rat race because of what other people might think. Now, step 4 is to plan for the worst things to happen. The last part of a solid financial plan, being able to weather a financial storm long enough to make sure you can still benefit from the rewards of compounding. Housel warns that people are too optimistic with their finances, meaning they'll put too much of their wealth at risk at any one time on any one strategy, which could end up blowing up in their face. Lesson 4, how to create a financial strategy you can stick to. So Housel has painted a picture of what your plan should look like, but we all know that creating a plan and sticking to a plan are two different things. So how do we do this? Well, there are key principles to follow. Expect your future goals to change and optimize for sense over logic. Having the expectation that goals could change over time is something which Housel recommends. The reason for this is you want to develop a long-term strategy which you can follow over decades. As we spoke about in the previous lesson, the ability to leave your money and let it compound is where we get the best returns from. Housel explains in the book that when people make financial plans, people fall victim to the end of history illusion. Now, this is a psychological phenomenon where you recognize that you've changed a lot up to this point, but you don't expect yourself to change a lot in the future. Given the fact you've changed a lot up until this point, it's unlikely that you won't continue to change as you go through life. In order to protect yourself from this, Housel recommends that you should not make an extreme financial plan. For me, this is one of the true pieces of wisdom from this book. You want something which is simple and you can continue to do over the long term. I personally think the best way to do this is via property investing, which is the perfect time to tell you about our investor newsletter. And we can break down how to invest into property along with any major news updates and some live deals. So if that sounds of interest to you, please take a look at the description below and I'll pop the sign up link down there. The second point to being able to stick to a robust financial plan is to make sure you're being sensible, not necessarily logical. Housel argues that when people think about a logical strategy, they're focusing on maximizing the amount of money they can make. But this fails to factor in the peace of mind which it can cost someone. Whereas if you have a sensible approach, which is simple and low risk, like investing in an index fund over the long term, there are fewer sleepless nights compared to having all of your net worth tied up in a JPEG of a monkey. This sensible strategy will ultimately make you more money over the long term due to the fact it's easy to stick to, not forgetting the non-financial elements such as the peace of mind. If you're in a high-risk investment class and you have all of your net worth tied up into it, this is going to give you some sleepless nights. So when we factor all of this together, the sensible strategy is the way to go. Lesson 5, how to counter negative thinking. So we have a plan, we know how to stick to the plan. Thanks for that, Big Morgan. But what happens when, as Bob Dylan says, these times are a-changing? How do we react? How do we make sure we avoid a negative mindset through it all? Housel shares one key piece of advice when it comes to reacting well to bad news. Don't be put off by uncertainty. He argues, rightfully as I see it, that if you're investing in the market for long enough, you must accept feeling of uncertainty as the market fluctuates. If you do not, it's likely you'll be able to endure the uncertainty long enough to let your returns compound. Housel explains that investing is inherently uncertain. For example, the longer you let your stocks compound, the longer you have to feel the uncertainty as you're in the market for longer. This discomfort is inevitable and it's the price you have to pay. This is where most people try and limit the amount of uncertainty they experience by trying to time the market. But this is impossible to do and you'll end up losing money. It's key here to remind yourself you'll be trading short-term peace of mind for a long-term gain. Lesson 6, how to pay attention to the right financial information. Finally, Housel says it's important to pay attention to the right financial information for your personal financial plan. Pay attention to the right information. Housel suggests we need to know what financial goals matter to us personally. This is key to prevent us from getting caught up chasing other people's goals. The last thing you want to do is to get caught up in the crowd and start investing in a class you know nothing about just because you're experiencing some FOMO. We've witnessed this sort of behavior with crypto over the last couple of years. Housel advocates for each of us to write down our own mission statement for our finances, asking ourselves two key questions. How long will you invest the money for, and what do you expect or hope will happen over that time? Once we have a focus, we can easily discount irrelevant information that's not going to support our plan. Instead, we'll be able to focus on information that's relevant to our financial goals, therefore making better decisions. For me, the psychology of money was critical in building up my psychology around property investing and investing generally. Making a financial plan and sticking to it is super important, and I've been guilty of shiny penny syndrome in the past, jumping from one approach to the other. And I know if I'd stuck at things long enough, I would have been a lot further along. Now let me know what you think about these lessons from the book in the comments below, and if you enjoyed this video, please check this one out. Make sure you subscribe, and I'll see you in the next one.